All right, let's dive into international economics. We've got a textbook, some case studies, and a journal article.
Yeah, but don't worry, this isn't just going to be dry theory and graphs,
Right. It's about stuff that really impacts the world.
like why some countries dominate certain industries.
Yeah, or how a tiny change somewhere can cause, like, a financial earthquake everywhere.
Exactly.
So by the end of this, you'll get the main ideas.
And hopefully some, like, aha moments,
If
too.
it all clicks and you see the world differently,
Yeah.
who knows, you might even be able to predict the next currency crisis.
Okay, maybe not that.
But let's demystify this stuff. Now, the textbook jumps into this thing called the gravity model of trade.
Oh, yeah.
I have to admit, it really caught my eye.
It's pretty cool.
It's not just about, like, who makes what better.
It's about how big the economies are and how far apart.
Yeah, like planets and their gravity.
Exactly. Bigger economies, closer together, they trade more. It's like a pull.
But then there are things that work against that pull.
Like borders. Even friendly ones.
Yeah, the example in the book is the U.S. Canada border.
You'd think, best buds, trades can be super easy.
But even that line makes trade less than if it was just, like, the same distance within one country.
It's weird.
It's not just tariffs either. It's subtle stuff.
Regulations, cultural things, even what people like to buy can be different enough to cause friction.
Makes you wonder how much we're influenced by these invisible forces, you know?
It's wild. And then you add in this idea of increasing returns.
That one kind of blew my mind. Making more can actually lower the cost per unit.
It seems counterintuitive.
But when you think about, like, Silicon Valley or Hollywood, it makes sense.
Those industries cluster for a reason.
Specialization, economies of scale, knowledge spilling over between companies.
Even competitors. Imagine you're starting a tech company. Wouldn't you want to be where everyone else is, even if they're your rivals?
It's like a giant brain trust, constantly learning from each other, leading to cheaper and better products for us.
And it explains why countries both export and import similar stuff.
Like cars. We think Germany just exports cars.
But they import them too.
So it's not just about who's better at making a car. It's about specializations within that industry.
Some countries might be luxury cars, others fuel-efficient ones.
Gives us more variety. Which brings us to the Ricardian model.
Ah, yes.
I'll be honest, at first glance, it can seem a bit dry.
It's deceptively simple, though, but powerful.
The textbook uses cheese and wine, right?
Two countries specializing shows how they both benefit, even if one's worse at making both things.
It's not about being good overall, it's about the relative advantage.
Like jack of all trades, master of none.
Even if you're good at everything, focus on what you're best at, then trade for the rest.
And this applies to labor, too.
Right. Countries specialize in the kind of work they have a comparative advantage in.
Which leads to this idea that as trade grows, wages should even out across countries.
Controversial, right.
It's not a perfect system. Lots can get in the way.
Regulations, how easy it is to move between countries, technology differences.
But the model highlights those forces pushing towards equal wages and how trade can raise standards of living.
But the real world's messier than our neat models.
Oh, absolutely. And that's where the specific factors model comes in. Add some realism.
Right. It acknowledges that not all resources are equally adaptable.
Yeah, some workers and capital get stuck when trade patterns change.
It's like teaching an old dog new tricks. Some skills are very specific to one industry.
And if that industry shrinks because of imports, those workers have a tough time.
And this is where politics get involved. People hurt by imports, they lobby hard for protection.
Even if those policies are bad for the overall economy.
The textbook had this stat that really hit me. U.S. apparel workers, they make 25% less than the average worker.
Wow.
So yeah, they're going to resist cheaper clothes from imports, even if it's good for everyone else.
It gives you to think about your own choices, right?
Yeah.
Have you ever been for or against trade restrictions? Why?
It really brings these models down to earth. How our own little decisions connect to this big web.
And who wins and loses?
Which leads to another model based on what a country has a lot of.
The Heckscher-Ohlin model. It says trade's driven by these factor endowments.
So like skilled labor, capital, land, natural resources, all that.
Whatever each country is abundant in. Makes sense, right? They'll export stuff using those abundant factors.
Sounds intuitive. Export what you got, import what you lack.
But it's actually caused a lot of debate.
Really? Why?
Well, one of the main criticisms is that it predicts this thing called factor price equalization.
Meaning?
Wages, Interest rates, returns on capital, all that should become the same
Hmm.
across countries as trade grows.
Does it?
Not always.
Ah, so the model's wrong.
Well, it highlights that there are other forces at play,
Like what?
things that prevent this perfect equalization from happening.
Okay. But tying back to real life, there's been a lot of worry about wage inequality in developed countries.
Right.
And some blame it on trading with countries that have tons of low-skilled labor.
Makes sense on the surface. But the data is more complicated than that.
So is the model just totally useless?
No. It suggests trade should raise wages where that factor is abundant. So in a developed country with lots of capital and skilled labor, those wages should go up.
And low-skilled wages go down.
But technology seems to have a much bigger impact, especially automation.
So it's not just trade, it's how tech is changing the jobs themselves.
Much more complex than just saying trade did it. And then we get to this whole other world of economies of scale and imperfect competition,
Ah, yes. The textbook uses cars again as an example.
where a few big companies run the show globally.
And they're not just competing on price. It's quality, design, brand recognition, all that.
Very different from this idea of perfect competition.
Where you've got like a million tiny firms all selling the exact same thing.
Right. So in this world, the size of the market matters a lot.
A bigger market means more companies can exist. They each produce more. Costs go down.
And that's good for us, the consumers, right? Lower prices, more options.
And globalization has supercharged this. Trade barriers are down. Firms can sell anywhere.
Think about Silicon Valley. They cluster there not just for cheaper costs, but for those knowledge spillovers.
Everyone's so close together. Ideas are flying around, even between competitors. It's like
a giant beehive of innovation.
Exactly. And that brings us to multinationals, offshoring, and foreign direct investment.
FDI.
The textbook makes a distinction. There's horizontal FDI, where a company does the same thing in multiple countries.
And vertical, where they break up production steps and do each in a different location.
And then there's offshoring, which can be through your own subsidiary or outsourcing to another company entirely.
Well, it gets complex, right?
Cost considerations, access to resources, strategy, all playing a part.
And the journal article adds this key point. Offshoring isn't for every firm. Only those at a big enough scale really win.
Otherwise, the costs of setting all that up outweigh the savings.
Fascinating, isn't it?
It makes it real. These aren't just theories, they're choices companies are making every day.
Impacting all of us.
Absolutely. And to understand this interconnected world, we gotta understand trade policy. Starting with, well, the good old tariff.
Classic, right?
When I first learned about tariffs, I thought it was simple. Just protect your industries, done.
It's never that simple in international economics.
No kidding. The textbook does a decent job explaining the basics, like how they impact prices, who they help, who they hurt.
But then you get into stuff like the effective rate of protection.
Well, yeah, and things get way more nuanced.
Because you got to factor in not just the tariff on the final product, but the tariffs on all the inputs, too.
What goes into making the thing.
Exactly.
And sometimes a tariff on the parts actually protects an industry more than a tariff on the finished good itself.
Wild, huh? It's like a domino effect. Tariff on steel raises the cost of cars, even if cars themselves aren't taxed more.
So, yeah, it helps car makers here, but it also hurts us buying those cars.
It's like this giant puzzle. All the pieces are connected in ways you don't always see right away.
Especially when you think about stuff with really complex supply chains.
Electronics, for example.
Yeah, like how the heck do tariffs even impact those?
Big question.
In a world that's so connected, do these old tools, like tariffs, even work anymore?
Or is something new taking over?
That's a great question. And it takes us to the debate that's like always there. Free trade versus protectionism.
The classic. Is free trade always best? Or are there times when you need to protect yourself?
One of the main arguments for protection is this infant industry idea.
New industries need some shielding until they can compete. Common in developing countries.
Sounds good, but the textbook points out it rarely works out the way you want.
The protection often becomes permanent. You end up with inefficiency, not growth.
Like that example, import substitution industrialization.
Huge in Latin America in the 20th century.
Trying to replace imports with stuff made domestically.
Ended up with high costs, crap quality, and they couldn't compete internationally.
So is there any good reason to mess with trade, even for a little while?
Well, economists sometimes say, yeah, if there's a market failure,
Hey,
the free market isn't getting it right on its own.
like what?
If a good has positive spillover effects, benefits beyond just the buyer and seller that the market doesn't account for.
Okay. Give me an example.
Renewable energy.
Hmm?
Investing in that has benefits for everyone, not just the companies making the tech.
Or research and development.
Exactly. Those things might need a little push from the government to get going.
Interesting. So it's not just models and theories, it's about making choices in the real world.
With consequences.
Yeah, and sometimes those choices are tough.
Absolutely. And we can't avoid the whole globalization debate. Concerns about exploitation, the environment, jobs being lost.
The anti-globalization movement cites some points.
They argue that corporations and the elite have benefited at the expense of everyone else.
But is it really that simple?
Let's think back to the Ricardian model. Remember how we showed trade can be good for both countries, even if their wages are vastly different?
It's not automatically exploitative just because one country's richer?
The example in the book is Japan and Vietnam. Japan having higher wages doesn't mean Vietnam's losing from trading with them.
Okay, but what about the environment? All this shipping and stuff, isn't that bad?
Valid question. The textbook brings up this idea of the environmental Kuznets curve.
Never heard of that.
It basically says that pollution goes UP as a country develops at first. Then it starts going down as they get richer and can afford cleaner tech.
So there's hope?
Maybe. As countries grow, maybe they'll get greener too.
But it's not guaranteed, right?
Depends on government policies, companies, even what we as consumers choose.
It's a reminder that globalization isn't just one thing. It's this constantly changing process.
We can shape it for good or for bad.
Right. But now let's switch gears to something a bit more volatile.
Finance and exchange rates. Now, this is where it gets interesting. I mean, exchange rates impact the price of everything.
From your coffee to, the entire global financial system.
It's all about how much one currency is worth compared to another.
And those values.
Yeah.
Always changing, up, down, all over the place. Driven by supply, demand, interest rates, and honestly, sometimes just how people are feeling about the economy.
Can be a wild ride.
But there's logic under it all. The textbook talks about interest rate parity. Investors want to put their money where it earns the most.
Makes sense.
But they got to factor in how exchange rates might change, too.
So if interest rates go UP in one country more than another?
Their currency will probably get stronger. People want those higher returns.
Oh, okay. Now, this next one sounded intriguing. The impossible trinity.
Ah, yes. Or the trilemma.
What's so impossible about it?
It says a country can only have 2 out of these 3 things. Free capital flows, a fixed exchange rate, and independent monetary policy. Whoa. So, you can't control your interest rates if you also want to fix your currency A and D. Let money flow in and out freely.
Yep, that's the dilemma. Explains why most major currencies today, they just float.
They've chosen control over their economy and the free flow of money.
Over a fixed exchange rate.
But some countries still fix their exchange rate.
They do. It works out for some better than others.
So which is the right answer?
There isn't one. It depends on each country's situation.
How developed they are, their economy, how vulnerable they are to shocks from outside.
It's about finding the right balance for you.
Stability versus flexibility.
Control versus openness.
And this balance matters even more when you consider how much money's moving around the world now.
Financial globalization.
It's like we're all connected by these financial threads. A shock in one place can jolt the whole web.
The potential for both good and bad gets amplified.
Right.
The textbook explains how banks are at the heart of this.
They lend money, but they also create this thing called leverage.
Which basically magnifies gains and losses.
So it can make good times great.
And bad times a disaster.
We've seen it happen.
Financial crises, the Asian crisis, the global crisis of '08.
They showed just how connected everything is, how fast problems can spread.
And it taught us how important regulation is. Having strong institutions, countries working together.
To prevent those crises, or at least make them less bad.
We need a system that can bend, not break.
Not just reacting after the fact, but building in resilience from the start.
Exactly. And that means not just finance, but the whole economy. Diversifying, education, good governance.
Creating a cycle where development benefits everyone.
Now, the textbook uses this term, original sin, which sounds kind of scary.
It does. What's that about?
It's a problem for a lot of developing countries. They can't borrow money in their own currency.
They have to use dollars or euros.
Which leaves them vulnerable to exchange rate risk.
Oh, so if their currency gets weaker, suddenly they owe way more.
Nightmare scenario. Limits their options, makes them susceptible to those external shocks. Imagine you're a business there, needing a loan.
Yeah.
Wouldn't you rather borrow in the currency you use?
It's common sense. So why can't they?
Lack of trust, often.
In their own money.
Maybe they've had high inflation, volatile exchange rates. They've defaulted on loans before.
So investors want the safety of dollars.
It's a vicious cycle. Can't borrow in your own currency because you're risky, but you're risky because you can't borrow in your own currency.
How do you even get out of that?
Not easy. Developing local bond markets might help, but that takes time to build trust.
Maybe regional currencies, like a mini euro.
Could work, but countries got to be willing to give up some control.
Yeah.
Or maybe indexing debt to commodity prices so it's not all on the currency itself.
But that comes with its own risks too, right?
Always trade-offs.
This is why I love international economics, but also why it's so frustrating.
It's unpredictable.
Now, the book talks about countries stockpiling foreign exchange reserves. We touched on it before, but developing countries especially have been doing this like crazy.
Big puzzle.
One reason's got to be past crises. They got burned before, so they want to be ready next time.
It's like a giant national emergency fund, but it comes at a cost.
Yeah, all that money sitting there, they could be doing something more with it.
Opportunity cost, for sure. But compared to a financial meltdown, maybe that cost seems small.
It's like insurance, right? You pay, hoping you never use it.
And this is especially true for countries with fixed exchange rates. If investors suddenly pull out, they need those reserves to defend their currency.
Okay, so that's about being cautious.
But some might be using it strategically.
Strategically.
Keep their currency weak on purpose, boost exports, run trade surpluses.
Sounds sneaky.
It can lead to conflict with other countries.
Yeah.
Accusations of currency manipulation.
So, gotta find the sweet spot, huh?
Enough reserves for stability, not so much that it messes up global trade.
Like Goldilocks. Not too much, not too little.
Exactly. And the just right amount depends on each country.
What about the IMF? What's their take on all this?
The IMF, they're interesting. Born after World War II, their whole thing was to stabilize the world's money system.
To keep things running smoothly.
For a long time, they were mostly about short-term loans to countries with balance of payments problems.
Like a global lender of last resort.
But their loans often come with conditions.
Austerity measures, reforms, all that. Which some say is too harsh.
It's been controversial. But the IMF has changed over time. More sensitive to the social and political stuff now, and they do more than just lend.
Oh, like what?
Technical advice, they monitor the global economy, do tons of research.
So they're like the world's economic advisor now.
You could say that. They play a big role in shaping global policy.
But things change fast, and some say the IMF is slow to keep up.
With China's rise, emerging markets getting more powerful, all the complexity in finance, it's a challenge.
To stay relevant, they gotta adapt.
Change their governance, make sure everyone's interests are represented.
It's like a giant ship trying to stay afloat in a storm. Speaking of giant things changing the world, we gotta talk about China.
The elephant in the room.
It's amazing. In such a short time, they went from basically closed off to a global economic powerhouse.
Second largest economy now.
Major player in trade and finance. But not without controversy.
Oh, definitely not.
Is it just because of their economic model?
State capitalism mixed with market forces.
Yeah, that's unique.
Some criticize their currency, saying it's kept artificially low to benefit their exports.
Like they're cheating at the trade game.
Others worry about intellectual property theft, being forced to share technology, their financial system being opaque. Lots of tension. People want them to change.
It's a tough spot for the rest of the world.
Yeah, because China's good for global growth. They invest a lot. They're a huge market.
But then there's this unease about unfair practices.
So how do you work with them and protect your own interests at the same time?
Delicate balance. And this is happening while the whole idea of globalization itself is being debated. Yeah, we've been more and more connected for decades now. Good for consumers, businesses can sell anywhere, more opportunities.
But there have been losers, too. Jobs lost, damage to the environment.
A feeling that some people are getting left behind?
It's fueled this backlash. Populism, protectionism, a sense that the old ways aren't working anymore.
So is globalization over? Are we going back to everyone just looking out for themselves?
I don't think it's that simple.
Maybe it's not ending, just changing.
Evolving.
Regional trade deals, more stuff happening online.
The world's rewiring itself.
And all this is happening while technology's changing everything, too.
Oh, yeah.
AI, automation, the digital economy. It's like a sci-fi novel come to life.
And it's impacting trade and finance in huge ways.
E-commerce makes it easier to sell across borders, but then how do you tax it? How do you regulate it?
And automation's taking away jobs everywhere.
Inequality is getting worse, people are worried, and some are getting angry.
Tech can be awesome, but it can also make bad stuff worse.
So how do we use it for good? How do we make sure everyone benefits? How do we create a future where tech makes things better for everyone?
The big questions, right?
International economics gives us the tools to think about these things. Trade, finance, development.
It's all connected.
We left off talking about those big financial crises, the ones that really shook things up.
Yeah, it's like you see it coming but can't stop it.
The textbook mentioned that tequila crisis in Mexico. Back then, it seemed like something happening far away.
It shows how a fixed exchange rate can backfire when lots of money's flowing in.
They had pegged their peso to the dollar, right?
Made it attractive to foreign investors.
Like a guaranteed return.
But it also creates a moral hazard. Investors get less careful, take bigger risks.
Because they think they're protected.
And for Mexico, that risk came from several places. Politics, U.S. interest rates going up, their trade deficit growing.
Investors got nervous, pulled their money out. Boom, the peso crashed.
It's like that game, Jenga. One wrong block and the whole thing collapses.
And if one currency falls, it can trigger a domino effect.
Like the East Asian crisis. Several countries, all around the same time.
Was it just panic? Like everyone freaking out because their neighbor was in trouble?
It was deeper than that. Places like Thailand, Indonesia, South Korea, they'd been booming.
But they were also borrowing a lot, right?
Huge current account deficits, lots of short-term debt, and in foreign currencies too.
So they owed money in, like, dollars, not their own currency.
Risky move.
Yeah.
And a lot of it went into real estate, speculative stuff, creating bubbles. When those burst.
Panic, for sure. Investors bail, currencies tank. It's a self-fulfilling prophecy.
Exactly. So what's the lesson here?
Fixed exchange rates, lots of money flowing in, pile on the debt, add a dash of panic. Recipe for disaster.
You need to manage those flows carefully, especially for developing countries.
Let the currency adjust, like a shock absorber.
But you also need strong institutions to handle all that money. Good banks, clear rules, a legal system that works.
So you can weather the storm, not just react when it hits.
Building resilience.
And not just in finance, but in the whole economy.
Diversify, invest in people, make sure the government's doing its job right.
Okay, all that makes sense. But the textbook uses this phrase, original sin. Sounds ominous.
It refers to this problem a lot of developing countries have. They can't borrow money in their own currency.
They have to use dollars or euros.
Leaves them exposed if their own currency weakens.
Their debt gets way bigger.
A major headache. It limits their options, makes them super vulnerable to those external shocks.
It seems like if you're a business there, you'd want to borrow in your own currency.
Of course. But it often boils down to a lack of trust.
Trust in what?
Their own money. Maybe they have a history of high inflation, or their exchange rate's been all over the place.
Or they've defaulted on loans before.
Exactly. So international investors, they want the security of the dollar.
It's like a catch-22. They're seen as risky because they can't borrow in their own currency, but they can't borrow in their own currency because they're seen as risky.
It's a tough cycle to break. Developing those local bond markets would help.
But that takes time, right?
Build confidence. Maybe regional currencies could work.
Like a mini euro, but just for certain countries.
That's an option. Or pegging their debt to commodity prices instead of another currency.
But then you're at the mercy of those commodity markets.
Trade-offs. There's never a perfect solution.
This is why international economics is so fascinating.
Unpredictable. Now, remember how we talked about countries stockpiling foreign reserves?
Yeah, especially developing countries, they've been hoarding them like crazy.
It's a puzzle.
Part of it's got to be that they got burned before. Crises in the past.
Like a rainy day fund for the whole country.
Yeah.
But there's an opportunity cost to that, right?
Yeah, that money could be invested, used for other things.
But compared to a full-blown economic crisis, that cost might seem small.
It's like paying for insurance. You hope you never need it, but it's there if things go bad.
And this is even more true if your exchange rate is fixed. When investors get spooked and pull out, you need those reserves to defend your currency.
Okay, that's being cautious. But aren't there other reasons countries do this?
Some might be playing a bit more strategically.
Strategically, how?
They might want to keep their currency weak on purpose to boost their exports.
So they can sell more stuff overseas.
Exactly. This can lead to accusations of currency manipulation. Creates tension.
So it's like this balancing act. You need enough reserves to keep things stable, but not so much that it distorts trade and makes other countries angry.
Finding that sweet spot.
What about the IMF? They're like the global financial tops, right? What's their take on all this?
The IMF is interesting. They were born after World War II to stabilize the global financial system. promote cooperation.
Make sure things run smoothly.
For a long time, they were mostly about lending money to countries facing balance of payments problems.
Kind of like a global lender of last resort. But their loans come with conditions, right?
Often. Austerity measures, sometimes painful reforms. It's been controversial.
Critics say it's too harsh, that it hurts regular people while benefiting investors.
That's a valid concern. But the IMF's changed its approach. They're more aware of the social and political stuff now. And they do more than just lend.
What else do they do?
They provide technical advice. They monitor the global economy, do a lot of research.
So they're more like a global economic advisor now.
Yeah, you could say that. They have a big influence on policy.
But the world's changing fast.
And some say they're slow to adapt.
With China's rise, emerging markets getting more powerful, finance getting more complex, it's a challenge for them.
They need to stay relevant, change their own governance, make sure everyone has a voice.
Like steering a giant ship through choppy waters. Speaking of which, we got to talk about China.
The big one.
In a few decades, they went from a closed-off country to an economic powerhouse.
Second largest economy in the world now. Major player in trade and finance.
Impressive. But it hasn't been without controversy.
Lots of controversy, actually.
Is it just because of their economic model, that mix of state control and free markets?
It's more nuanced than that. Some people say they manipulate their currency, keep it weak on purpose to boost exports.
Give them an unfair advantage.
Others worry about intellectual property theft, forced technology transfer, lack of transparency in their financial system.
Lots of tension, calls for reform.
It's a tough situation. China's a major driver of global growth. They invest a lot. They're a huge market.
But there are concerns about fairness, about transparency. How do you work with them while also protecting your own interests?
It's a balancing act. And this is all happening as the whole idea of globalization is being debated.
Yeah, for decades, the world's been getting more and more interconnected. Cheaper goods, businesses can sell anywhere, lots of new opportunities.
But there have been downsides. Jobs lost, damage to the environment.
A feeling that the benefits aren't being shared equally.
This has fueled a backlash against globalization, a rise in populism, protectionism.
So, is globalization over? Are we going back to everyone for themselves?
I don't think it's that simple.
Maybe it's not ending, just changing.
Evolving. We're seeing more regional trade deals, more happening online.
The world's rewiring itself. And all of this is happening as technology is changing everything.
Artificial intelligence, automation, the digital economy.
It's like we're living in a science fiction novel.
And it's having huge effects on international trade and finance.
Think about e-commerce. It's made it so much easier for businesses to sell across borders. But it's created new challenges for taxation and regulation.
And automation. It's taking away jobs.
In developed and developing countries, it's increasing inequality, causing unrest.
Technology is a double-edged sword. It can be a source of amazing opportunity, but it can also make existing problems worse.
So how do we use it for good? How do we create a future where everyone benefits? We were just talking about how technology is changing everything.
It's super obvious in finance.
Yeah, all the stuff with digital currencies, blockchain.
Fintech startups disrupting the old banks.
It's a whole new ballgame. But how do you even regulate something like crypto? It's so decentralized. No borders.
It's a nightmare for regulators, honestly.
I bet.
These innovations could make finance more efficient, more inclusive, even more transparent. But there are also risks.
Cyber attacks, people's data getting stolen.
And this thing called regulatory arbitrage, where companies exploit the differences in laws between countries.
So they just go where it's easiest to get away with stuff.
Pretty much. It's a game of whack-a-mole for regulators. You close one loophole, another one opens up somewhere else.
So what can they even do?
It requires countries to work together. No one nation can handle something as global as the internet or crypto. We need shared rules, information sharing, coordinated action.
Otherwise, it's a race to the bottom, right?
Exactly. Companies will just go to whoever's got the weakest rules.
So it's about finding that balance, encouraging innovation, but managing the risks.
And you got to think globally. What's good for one country might not be good for everyone.
It's like we're all in the same boat now. We've been talking around this idea of sustainability throughout our deep dive.
It's kind of the underlying theme, right?
Connecting everything we've talked about.
Sustainability is not just for tree huggers anymore. It's a core issue for businesses, governments, everyone.
It's about the big picture, making sure economic growth doesn't screw over the planet or future generations.
Exactly. And the choices we make in international economics have a huge impact on that.
Trade deals, how money flows around the world, technology spreading, it all matters. So this is where we leave you with a question. What kind of world do you want to live in?
What role can international economics play in making a future that's both prosperous and sustainable?
Tough
No
question.
easy answers. It's about making those tough choices, understanding how everything's connected,
And being willing to challenge how things are done now.
thinking globally, acting locally, realizing that our individual decisions can have a ripple effect around the world.
So be informed, get involved, be part of the solution. This has been a wild ride.
It has. From the gravity model to the impossible trinity to, well, pretty much everything shaping the world today.
We've only scratched the surface, but hopefully you've learned something new.
Challenge some of your own assumptions.
I'm even got a little excited about international economics.
Thanks for joining us on the deep dive.
We'll be back soon with another deep dive into a topic that matters.
Until then, stay curious.
Did you get any of that?